What if I told you that the 4% rule, the gold standard of retirement planning for decades, isn't the guarantee it once was? And what if that $1 million nest egg you've been dreaming of, what if that only lasts you 15, maybe 20 years? This isn't a scare tactic. For millions of retirees, this is becoming their new reality. And the reason is a silent predator that's stalking your savings account: inflation. We've done the math, and the numbers are genuinely startling. The official stats you hear on the news don't paint the whole picture. They don't show you your personal inflation rate. And that number, the one that reflects your real life, is what will decide the fate of your retirement. So stick with me, because today we're pulling back the curtain on the real impact of rising costs. And more importantly, we're going to lay out a clear, actionable plan to build a financial fortress around your hard-earned money. Later this week, we're going to go deep on the Fed trap, the 99.5% probability of a hold at Wednesday's meeting, the Hormuz blockade, and what it all means for your cash. That video drops Wednesday morning. But today, I want to start somewhere more personal, because the macro picture only matters when you see what it actually does to your retirement timeline. And before we get into the math, and trust me, you want to see this math, I want you to know that TimTalksFinance.com has a free retirement calculator waiting for you right now. When I tell you a number, you can run your own. No guessing, just your actual situation. 5 minutes, free. Link in the description. Okay, let's get into it. Let's talk about the elephant in the room, the official inflation rate. You see it on the news, that one little number, the Consumer Price Index, or CPI. As of March 2026, the annual inflation rate was sitting at 3.3%, according to the Bureau of Labor Statistics March CPI report. Now, that doesn't sound so bad, right? Especially when you think about the nearly 9% spike we saw a few years back. The government and the financial news might even call it cooling. But here's the first dangerous illusion of retirement planning. Cooling inflation doesn't mean prices are dropping. It just means they're going up a little bit slower than before. The sky-high prices you're paying right now for groceries, gas, and electricity, they're the new normal. That huge surge in costs from the past few years has been baked into the economy, and it has permanently raised the cost of living for your entire retirement. But the even bigger problem is that the CPI is just a national average. It's an economic theory. It's not your life. The CPI tracks a basket of goods and services, and it's almost impossible that your personal spending habits perfectly match that basket. For retirees, this gap is even wider. What a 25-year-old buys is completely different from what a 70-year-old needs. And one of the biggest expenses for retirees is healthcare. The BLS confirmed in the March report that medical care services rose 3.7% year over year. The 2026 Social Security COLA was 2.8%. So right out of the gate, your COLA is already running behind on the single largest expense category in retirement, before you've bought a single grocery item. This brings us to the real heart of the problem: the slow, quiet burn of your purchasing power. This is how inflation invisibly eats your retirement. It's not a big, dramatic market crash. It's a gradual erosion that, over time, is just as devastating. Let's do some quick math. Think about your weekly grocery bill. Let's say today you spend about $200 a week. At a 3.3% inflation rate, in 10 years, those same groceries will cost you $277. In 20 years, $384. And in 30 years, when you might be in your later retirement, that same weekly bill will be $532. You're buying the exact same stuff, but the cost has more than doubled. Your money is worth less than half of what it was. At a 3% inflation rate, the cost of living doubles roughly every 24 years. Now apply that idea to your entire nest egg. Every single dollar you've saved is constantly, silently losing value. This is the central threat. While you were working, you probably got raises that helped you keep up with inflation. But in retirement, you're on a fixed or semi-fixed income. There's no rising salary to protect you anymore. You have your savings, maybe a pension if you're lucky, and Social Security. And two out of those three are incredibly vulnerable. It's like you're running a marathon, but someone is secretly moving the finish line further away with every step you take. You think you have enough to make it, but the goalposts keep shifting. This is why understanding your real, personal inflation rate isn't just a fun exercise, it's a matter of survival for your financial future. Okay, this is where we live up to our title. Let's do the math. We'll use a real world example. Meet Jane. Jane is 65. She's worked hard her whole life, and she's finally hit that retirement milestone. She even managed to save $1 million. It feels like a mountain of money, a fortress of security. Her plan is to follow the classic 4% rule. That rule says you can withdraw 4% of your savings in your first year of retirement and then adjust that amount for inflation each year after. For a long time, this was considered a pretty surefire way to make your money last for 30 years. Financial researchers at Morningstar have suggested that in today's environment, the safe withdrawal rate may need to be revised down to around 3.9%. I'll link their analysis in the description. That 0.1% difference sounds tiny. Applied to 30 years of compounding, it isn't. So, in year one, Jane takes out $40,000. We'll assume her $1 million portfolio is in a balanced mix of stocks and bonds and earns an average of 6% per year. In the old days, with inflation at a stable, low 2%, Jane's plan looked solid. The next year, she'd take out $40,800 to keep up with that 2% inflation. Her portfolio would still be growing, and the numbers worked. She could relax, knowing her money would likely last her whole life. But now, let's run those same numbers in today's world, the world you and I actually live in. Let's be optimistic and say inflation just averages 3.5% over her retirement. What happens now? Year one is the same. Jane withdraws $40,000. Her portfolio drops to $960,000, then grows by 6%, bringing it to $1,017,600. Year two, she adjusts for that 3.5% inflation. Her new withdrawal is $41,400. At the end of the year, her portfolio is at $1,034,688. Year 3, she takes out $42,850. Her portfolio is now at $1,051,698. Seems fine, right? The balance is still going up. But let's fast forward. The power of compounding is a double-edged sword. That 3.5% increase in her withdrawals starts to take bigger and bigger bites. After 10 years, Jane's annual withdrawal isn't $40,000 anymore. It's over $56,000. After 20 years, she'll need to pull out nearly $80,000 just to buy the same things she did with $40,000 when she first retired. Her withdrawals start to grow faster than her portfolio. And then, the balance starts to drop. Once that happens, it falls off a cliff. Under this slightly higher inflation, that $1 million that was supposed to last 30 years might only last 22 or 23. If she lives to be 90, she could spend her last decade with no money left. And what if inflation averages 4%? Or we get another big spike? The timeline gets even shorter. This is exactly what we mean when we say inflation eats your retirement. It turns a 30-year plan into a 20-year gamble. And it's why some experts are now saying the new safe withdrawal rate is closer to 3.9%. And even that isn't a guarantee. Jane is a simplified illustration. Real investment returns fluctuate year to year, and this isn't a projection for any specific person. But the math principle is real, and you can run your own numbers in about 5 minutes. Here's what I want you to do right now, before we even get to the solutions. Go to timtalksfinance.com and use the free retirement calculator. Put in your actual savings balance, your withdrawal rate, and your assumed inflation rate. See your own timeline, not Jane's, yours. It's free. It takes 5 minutes. And seeing your own number is what makes this real. Link in the description. Here's what I'm personally watching. The Strait of Hormuz is still effectively closed as of this week. A dual US and Iran blockade with tanker traffic near a standstill. Rystad Energy estimates full oil flows won't be restored until at least July. The pass-through to consumer prices, shipping costs, airfares, manufactured goods, takes months to work through the system. JP Morgan's economics team published last week that their base case is now no Fed rate cuts for the rest of 2026, and they're not ruling out a hike in 2027. The April CPI, due May 12th, could show another surprise. And whoever Trump names as the next Fed chair after Powell's term ends May 15th could shift the entire strategy. I'm not predicting a doom scenario. I am saying this is real enough that preparing for it is the smart move. And that's exactly what Thursday's video is about. Now you might be thinking, but I'll have Social Security and a pension. I won't just be living off my savings. Fair point. Let's break it down. First, pensions. If you are one of the lucky few with a traditional pension, that's great. But you have to ask one critical question. Does it adjust for inflation? The vast majority of private sector pensions do not. A $3,000 a month pension sounds amazing today. But in 20 years, at a 3.3% inflation rate, that $3,000 will only buy you what about $1,560 buys you today. Your income is frozen, but the cost of everything has doubled. Your pension becomes a depreciating asset. Okay, so what about Social Security? That's the big one. The Social Security Administration set the 2026 COLA at 2.8%. Early analyst estimates for the 2027 COLA are in the 2.8 to 3.2% range. I'll link the latest projections in the description. Social Security is your lifeline. It's not your whole boat. But here's the catch. The COLA is calculated using an inflation metric called the CPI-W, which tracks the spending of urban and clerical workers. It does not track the spending of retirees. And as we've already said, retirees spend a lot more on things like healthcare, where costs tend to shoot past the general inflation rate. So year after year, your COLA gives you more dollars, but it may not be enough to cover the actual increase in your personal cost of living. It creates this nagging gap. Think of Social Security as a vital lifeline, not the whole boat. It'll help you stay afloat, but it won't necessarily get you to shore in comfort. This all points to one crucial task. You have to figure out your personal inflation rate. Forget the headlines for a second. Grab a piece of paper or open a spreadsheet and look at your own life. Where does your money really go? How much did your property tax or homeowner's insurance go up this year? What did you pay for a full tank of gas last year versus this year? Pull up a grocery receipt from a year ago and compare it to one from today. What about your health insurance premiums, your copays, your prescriptions? What about your hobbies, travel, or visiting family? When you add it all up, the number you get, your personal inflation rate, is probably going to be different and likely higher than the one on TV. That number is the most important piece of data for your retirement plan. That is the real enemy you need to prepare for. It's not about some theoretical economy, it's about the cost of your life. And once you know that number, you can stop fighting shadows and start building a real defense. All right, we've spent a lot of time on the problem, and the math can feel a little grim. But now we pivot. This is the most important part of the video because we are going to talk about solutions. The goal here isn't to scare you, it's to empower you. You've worked too hard and saved too long to watch your retirement dreams get eaten away. So now that we know the enemy, let's talk about how to fight back. Let's get into the specific strategies you can use to build an inflation-proof fortress around your savings. The core idea is simple. Your money has to grow faster than your personal inflation rate. Your savings can't just sit there, They have to be working for you. Let's start with the engine of your portfolio, your investments. Strategy number one, embrace stocks. I know, the stock market can be volatile, and that's scary when you're in retirement. But over the long haul, nothing has consistently beaten inflation by a wider margin. Think about it. Good companies can adapt to inflation. They can raise prices on their products to offset their own rising costs for labor and materials. That pricing power means their profits, and hopefully their stock price and dividends, can grow right along with inflation. I'm not talking about chasing risky, high flying tech stocks. I'm talking about a solid, diversified portfolio of quality, blue chip companies that make things people need no matter what the economy is doing. Companies in sectors like consumer staples, healthcare, and utilities. Strategy number two, own real assets. Inflation is just the price of stuff going up. So, a really direct way to protect yourself is to own some of that stuff. For most of us, the easiest way to do this is through real estate investment trusts, or REITs. When you buy a REIT, you're buying a small piece of a huge portfolio of properties. Think apartment buildings, warehouses, or shopping centers. As inflation pushes prices up, the value of those properties tends to rise, and the rents they charge go up too. That extra income gets passed on to you as dividends. It's a direct link to the very thing you're trying to protect yourself from. Strategy number three, use inflation-protected bonds. The US Treasury created a tool for this exact problem, Treasury Inflation Protected Securities, or TIPS. These are government bonds that are designed as a direct, guaranteed hedge against the official CPI inflation. Here's how they work. A normal bond pays you a fixed interest rate. If inflation spikes, the real value of your return drops. But with TIPS, the main value of the bond, the principal, is adjusted twice a year to match inflation. So if the CPI goes up 3%, the value of your bond principal goes up 3%. The interest you get is then paid on that new, higher amount. They're a fantastic tool for the safer, more conservative part of your portfolio. Strategy number four, add a sprinkle of commodities. When inflation is high, the prices of raw materials, like energy, metals, and agricultural products, tend to soar. Owning a small, diversified slice of commodities through an ETF can give your portfolio a powerful boost when inflation is running hot. Gold is the classic example, often seen as a safe haven when paper money is losing its value. But be careful here. Commodities don't pay dividends, and they can be incredibly volatile. They should be a small, tactical part of your strategy, not the main event. A balanced approach might look something like 45 to 60% in stocks, 10 to 20% in REITs, and maybe a 10 to 15% slice for things like tips or gold. Now let's move beyond your portfolio and look at some financial habits that can serve as your everyday armor. Strategy number five, put your cash and debt to work. That emergency fund you've built? It shouldn't be sitting in a traditional savings account earning practically nothing. In this environment, that cash is actively losing a chunk of its value every single year. Move it to a high-yield savings account or a money market fund. They offer much better interest rates that can help offset some of inflation's damage while still keeping your money safe and accessible. On the other side of the coin, look at your debt. The best kind of debt to have when inflation is high is long-term and fixed rate, like a 30-year mortgage. Inflation actually helps you here because you're paying back the loan with future dollars that are worth less than the ones you borrowed. But you have to be very careful with variable rate debt, like credit card balances, because those interest rates will rise with inflation, creating a dangerous financial trap. Strategy number six, review, rebalance, and stay flexible. Your retirement plan can't be a set it and forget it document you write at 65 and never touch again. You have to be the active CEO of your own retirement. At least once a year, sit down and review everything. Check your spending to see what your personal inflation rate is doing. Look at your portfolio and rebalance it to make sure your investments are still aligned with your goals. And be flexible. The 4% rule's biggest weakness is that it's so rigid. A lot of new research suggests a more dynamic approach, where you withdraw a little less when the market is down and a bit more when it's up, can dramatically extend the life of your portfolio. Strategy number 7, maximize your Social Security. For most people, this is the single best inflation adjusted source of income you can get. Like we talked about, the benefits go up with the COLA, and you can seriously increase your lifetime payout by delaying when you start taking it. For every year you wait past your full retirement age, up to age 70, your benefit goes up by about 8% permanently. That's a guaranteed, inflation adjusted return you just can't find anywhere else. If you're healthy and have other money to live on for the first few years of retirement, delaying Social Security is one of the most powerful moves you can make. Building an inflation proof retirement isn't about one magic bullet, it's about building layers of defense. It's about combining growth from stocks with direct inflation hedges like REITs and TIPS. It's about being smart with your cash and strategic with your Social Security. It's about going from being a passive saver to being the active, informed manager of your own financial destiny. A quick reminder, I'm not a licensed financial advisor. This is financial education based on 25 years in the mortgage and finance industry. Use this as a starting point and always work with a professional for decisions specific to your situation. So let's bring this all home. We started with a pretty jarring idea that the retirement you plan for is under constant, silent attack. We did the math and saw how even a seemingly small inflation rate can slash years off your financial security, turning a 30-year nest egg into a 20-year gamble. The old rules of thumb just aren't enough anymore. But we didn't leave it there. We laid out a 7-part strategy to fight back. We talked about owning growth assets like stocks and real estate. We looked at specific tools like TIPS, and we covered the practical steps of managing your cash, your debt, and getting the most out of your Social Security. This isn't about fear, it's about preparation. Knowledge is power, and understanding this challenge is the first step to beating it. You have worked too hard for too long to let the rising cost of living quietly steal your financial security. You have the tools, you have the strategies, you can take control. And if you want the full picture, your actual retirement readiness score, your ideal asset mix, and your 3 biggest financial risks based on your situation, I built a tool called My Financial Picture at timtalksfinance.com. AI powered, built on 25 years of finance experience, 12 questions, 5 minutes, $27. Less than a copay. Link in the description. Or if you want to talk through your specific situation with me directly, one-on-one, 60 minutes. I have a limited number of advisory sessions available each month for $250. This audience fills those spots fast. timtalksfinance.com. Work with Tim. Link below. On Thursday, I'm going to show you exactly which moves matter most right now, given everything we've covered this week. And one thing most people in the 45 to 65 window aren't considering, but probably should be. See you then. If you found this breakdown helpful, do me a favor and hit that subscribe button and the little notification bell. We're always breaking down the complex world of finance to give you clear, actionable information you can actually use. And now, I have a question for you. Think about your own budget. What's the one expense that has gone up the most for you in the past couple of years? Let me know in the comments below. I read every single one, and your stories help this whole community get a clearer picture of what's really going on. Thanks for watching, and here's to a secure and prosperous retirement.